Why paying off your mortgage early is a huge mistake. You've been told that paying off your mortgage early is the smartest financial move you can make. Dave Ramsey says it. Your parents said it. It feels right, but what if I told you that rushing to pay off a 3% mortgage while earning 10% in the market could cost you $147,000 over 30 years? I'm about to show you the math that financial advisors don't want you to see, and why keeping your mortgage might be the wealth-building decision that changes everything. The emotional versus mathematical truth. Let's be clear, paying off your mortgage feels amazing. The psychological win of owning your home outright is real, but feelings don't build wealth. Math does. Here's the uncomfortable truth. Your mortgage is likely the cheapest money you'll ever borrow. If your rate is under 5%, you're borrowing money cheaper than inflation, cheaper than investment returns, and cheaper than almost any other financing you'll ever get. Rushing to pay it off means you're choosing emotional comfort over financial optimization, and that choice costs 6 figures. The opportunity cost nobody talks about. Let's compare two people with identical situations. Both have $500 extra per month. Both have a $250,000 mortgage at 4% with 25 years remaining. Person A pays extra on the mortgage, sends $500 a month extra to the mortgage principal, pays off the house in 15 years instead of 25, saves $48,000 in interest. Feels great. Person B invests the extra $500. They keep paying the regular mortgage, invests $500 per month in index funds, averaging a 10% annual return. After 25 years, when the mortgage is paid off naturally, Person B has $649,000 in investments. After paying the remaining mortgage balance, Person B has $649,000 minus the mortgage interest they paid. The difference? Person B ends up with over $400,000 more wealth than Person A, despite making the same monthly payment. Wildly different outcome. Why your mortgage rate matters. This entire strategy depends on your interest rate. Here's the rule. If your mortgage rate is under 5%, invest extra money instead of paying down the mortgage. If your rate is over 6%, paying extra on the mortgage makes more sense. If your rate is between 5% and 6%, it's a judgment call based on your risk tolerance. Why? Because historically, the stock market returns 10% to 11% annually. Real estate appreciates around 3 to 4%. Inflation averages 3%. Your mortgage interest is tax deductible for many people, which effectively lowers your rate even more. If you're paying 3.5% on your mortgage but earning 10% in investments, that's a 6.5% spread working in your favor. Over decades, that spread compounds into massive wealth. The tax deduction you're losing. When you pay off your mortgage, you lose the mortgage interest deduction. For someone paying $12,000 annually in mortgage interest in the 24% tax bracket, that's $2,880 in tax savings every year. Pay off the mortgage, and that deduction disappears. Now you're paying $2,880 more in taxes annually. Over 20 years, that's $57,600 in extra taxes you're paying just to feel good about being mortgage-free. Financial advisors know this. Wealthy people know this. That's why rich people keep mortgages even when they could pay cash. They understand leverage. The liquidity problem. Here's what nobody tells you about paying off your house early. You're locking up hundreds of thousands of dollars in an illiquid asset. If you lose your job, get sick, or need cash for an emergency, your home equity doesn't help you. You can't pay bills with equity. You have to sell the house or take out a new loan. And if your credit or income situation has changed, you might not qualify. Meanwhile, if you'd invested that money instead, you have liquid assets you can access immediately. Your wealth is flexible and available when life happens. Real example breakdown. Let's use actual numbers. $300,000 mortgage at 3.5% interest, 30-year term. Monthly payment, $1,347. Scenario 1. Pay an extra $700 per month. Payoff time, 13.5 years. Total interest paid, $77,000. Total paid, $377,000. Scenario 2. Invest the extra $700 a month. Keep paying regular mortgage for 30 years. Total interest paid, $185,000. Invest $700 per month at 10% return for 30 years, $1,478,000. Net wealth after paying mortgage, $1,478,000 minus zero mortgage already paid through regular payments equals $1,478,000. The difference? Scenario 2 leaves you with over $1.1 million more wealth. Yes, you paid more interest, but you built exponentially more wealth. When paying off early actually makes sense. Situation 1. Your rate is above 6%. If you're paying 7% or 8% on your mortgage, that's expensive debt. Paying it off early likely beats market returns after accounting for risk. Situation 2. You're within 5 years of retirement. Entering retirement debt-free reduces your required income and provides peace of mind. The math might not be optimal, but the security is valuable. Situation 3. You have no emergency fund or investments. Don't pay extra on your mortgage if you have no savings. Build your emergency fund first, then invest, then consider extra mortgage payments. Situation 4. The emotional toll is too high. If mortgage debt keeps you up at night and prevents you from investing confidently, pay it off. Mental health matters. Just understand the financial cost. What wealthy people actually do. Here's what millionaires and financially savvy people do. They keep their mortgage, invest the difference, and use their investments to eventually pay off the house if they choose. Think about it. If you have $300,000 in investments earning 10% annually, you're making $30,000 per year in gains. Your mortgage at 3.5% on $300,000 costs you $10,500 in interest. You're net positive $19,500 per year just by keeping the mortgage and investing instead. Wealthy people understand leverage. They borrow cheap money to invest in assets that appreciate faster. That's how wealth compounds. The strategy you should use. Here's the smart approach. Keep your mortgage if the rate is under 5%. Max out retirement accounts, like 401k and Roth IRA first. Build a 6-month emergency fund in high-yield savings. Invest extra money in diversified index funds. Let compound interest do the heavy lifting for 20 to 30 years. Only after you've maximized all those wealth-building tools should you even consider extra mortgage payments. If the idea of having a mortgage stresses you out, compromise. Invest 80% of extra money, pay 20% extra on the mortgage. You'll still build wealth while making progress on the house. If you found this valuable, hit that like button, subscribe, and ring the notification bell. I drop new finance strategies every week that most creators won't tell you about. Also, visit Own Your Finance blog for more in-depth financial tips and hacks, whether it's mortgages, investing, taxes, home buying, and more. Don't forget to download my free guide, Finally Break Free from Living Paycheck to Paycheck, the simple 10-step budget that actually works, and start building real wealth today. Don't miss it. Thanks for watching and have a great day.